Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are pleased to welcome Patrick Fleury back to the channel. He's the CFO of TeraWulf. They just announced yet another big contract with Fluidstack backstopped by Google. We're going to be exploring the details and how this contract stacks up with some of the other hyperscaler colocation deals we've seen in the industry. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comments section below if you're currently holding shares of Wulf and what you thought about this most recent announcement. With that being said, let's get into today's video. All right, guys, away we go. Special guest, the CFO, Patrick Fleury of TeraWulf, hot off the heels of yet again another big hyperscaler announcement. Now, you guys have earnings coming up on the 10th. We're obviously going to cover those in about a week's time, but today's podcast, we wanted to pick your brain. We've seen a number of these type of deals in the market, comparing, contrasting them, and really looking under the hood in terms of what TeraWulf is building. So, Patrick, always great to see you. Welcome back to the show.
Thanks for having me. Miss you guys.
Of course, we've referenced our meeting in New York a few times. Some great insight there. Always a pleasure to have you on the channel. First and foremost, can you walk us through this most recent deal? It's a joint venture structure with Fluidstack and how this compares to the initial deal you guys signed, Fluidstack backstopped by Google.
Yeah, sure. So I think first off, really proud to be partners with all these folks involved here. It's basically the same deal as Lake Mariner, all the same parties, just with a couple simple differences. One is the Fluidstack, our partner here, right, was effectively a service provider at Lake Mariner and also a lease counterparty. And here, they are a joint equity holder, right? We own 51%, Fluidstack owns 49%. So happy to have them involved here in the equity. So that's, I think, number one difference. And then number two is important to TeraWulf. As part of that initial deal, Google took a 14% equity stake in TeraWulf. They're here, obviously, TeraWulf is not giving additional warrants here. So that was an important element of this transaction for TeraWulf. That being said, we are still, the JV is still benefiting from 1.3 billion of Google support, which will help us, just like it did the last time, go get the project level debt to finance this project. So I would say those are the two differences. This JV really, I think, came about because, as I mentioned to you guys, we haven't been out there touting a pipeline, and I know we'll get into this later in the conversation, and it's not for a lack of effort. I mean, we've looked at over 150 additional sites this year, but we really wanted to prove to ourselves and to prove to the market that we could go execute from A to Z in this space with, real partners in massive projects. And so I think for us, the culmination of that, right, was signing the lease and agreement with Fluidstack and Google in August, launching our convert to effectively provide the equity contribution down into the Aquila entity, and then doing a brand new process, which I'm very proud now is being copied by others, of taking this, data center design, financial engineering to the rating agencies, getting their blessing, educating them on it, and then taking that to the market to ultimately get, 3.2 billion of debt that's rated double B, right, in a 7.75% financing. As you guys know, that, in my opinion, that changed the game for financing data centers. And I think our team in general is getting pretty tired of being first at everything because it's hard. But I think for all of us right in this space, the demand here is bottomless. The problem is the capital is not, right? And so you have to come up with really new financing structures here to be able to access different pools of capital to attract the capital at a cost efficient price for us and our shareholders to be able to keep replicating this model. And I think, I couldn't be more proud of our team, from all the way from operations, all the way down through finance and everyone. I mean, as you guys have met many members of our team, including Paul, Kerry, Nazar, Stephanie, and so on, we have a really deep bench of folks that I think distinguishes us from our peers, which is one of the reasons we've been able to go and execute and be first. But yeah, really proud of that structure. And then this JV really, when I think of pipeline, there's multiple pipes that come into a big pipe. This, I think, was a small pipe that was not on folks' radar of we've executed with these JV partners now, soup to nuts. And so Fluidstack went, identified this site. We love it because it's Texas light. It is in Texas, but it is not in the ERCOT power system. It is in the Southwest Power Pool, which is commonly referred to as SPP. Why does that matter? You're going to hear this a lot from me because the supply, demand, and backlog dynamics in SPP are night and day versus ERCOT. And what do I mean by that? I'll just give you like high level stats. SPP, there's about 100 gigawatts of installed capacity. And on average, I think peak demand is about 55 gigawatts. So huge reserve margin there of installed capacity. Not a deep backlog for data center projects either. In ERCOT, you have an 85 gigawatt system with peak demand in the mid to high 70s, so not much margin, and you have over 200 gigawatts of data centers in the queue to connect. So that's a big deal. And so that is what I think, Fluidstack first identified, then asked us after we had been executing to come in, join them in the JV. And what I think we're also really proud of, and sorry, Bryce, I'm taking this in a bunch of different directions here, so hang with me. But this design, right, at the Abernathy site, our operations team, just showing how deep our bench is, this is the design that they worked with Fluidstack, Google, and our other folks that are involved, one of which Google has announced recently, at our site for over 3 months during the diligence process, right, over the summer, to come up with what is now the national design for these data centers. So they have now copied it at one of our peers, Cipher. And then we are doing it again at Abernathy. So again, all of that IP that was developed from, Nazar, Sean Farrell, our COO, all of our ops teams, like the folks that are on the ground at Lake Mariner, working in concert with all those big customers, came up with this design that's now being rolled out nationally. And so I think for us, just coming back to the JV with Fluidstack, these are partners we're really comfortable now with. We speak with on a weekly, daily basis. They are now comfortable with us because they've seen us execute from A to Z. And this was like a perfect opportunity. Again, just is additional pipe in that pipeline that I don't think was on folks' radar. And not only is it just, it's 240 megawatts gross, 168 net, right? We also have exclusivity on this site to the expansion, which we think we can do over time. And with Fluidstack, we have exclusive right to the next, roughly 200 megawatt project that they do anywhere in the US. So again, this is, I think, showing like a part of our pipeline, right, that had been kind of off folks' radar. But when you're partnered with, folks and everything is working and you've put a lot into it and it becomes easy, right? It's a way for us, I think, to add a lot of value over time to the company. And importantly, right, in this deal, TeraWulf is not the EPC, like the engineering, procurement, and construction, right? We do all of our own work, like building everything at Lake Mariner, and we will likely do that at Cayuga too. But we're a small company that's now a medium-sized company and growing. We don't have enough people to go do that at every single site around the country. So we've with Fluidstack's help here, brought in some other folks, including Hypertech, Maztech, Confi, a number of different folks that will be executing on the ground building this data center for us. And then we can provide the additional layer of expertise of, hey, this is what we're experiencing, building this capacity real time at our site, just giving the actual construction team at Hypertech a heads up on, hey, maybe you should think about this or how to troubleshoot. So that's great because it leverages TeraWulf to do other things. And so when I talk again a bit about pipeline and looking at over 150 sites this year, that requires an inordinate amount of time and due diligence. And you can imagine coming from our whole team that is power executives, everything we're looking for is kind of the same unicorn that we have in Lake Mariner and in Cayuga, which is a lot of existing infrastructure at the site and time to power quickly in a regulatory jurisdiction that we're comfortable with. When those are your focuses, the universe gets pretty small. And so the amount of time and energy that kind of goes into sifting through those 150 sites, really to get it to a handful, which is kind of where we are now. And now that we have the whole system from A to Z, I think you're going to see us really start to expand quickly here, which is something we're all really excited about.
Yeah, I was fortunate to catch up with Nazar at the AIM Summit in Dubai a few weeks ago, so caught up with him there. Before we go on to that sort of like, I've got another question on the design, but in terms of, I remember that SALT conference where you spoke eloquently about the discussion period you had with the client before agreeing a deal, and it was, I think, a 5 month process, 5 to 6 month process. How long have these subsequent discussions been to get these sort of like extended parts of the contract? Have they been sort of like, obviously from a time position, it looks like they've not took that long at all, but are they still sort of like challenging discussions? Or actually, once you've got that model in place, you both know where you stand. Is it a case of then it's I's dotted and T's crossed and let's move forward? Because we've spent 5 months getting to that point. Why would we want to change our position?
It's much more the latter, right? You've kind of cleared all the underbrush. We're comfortable with them. They're comfortable with us. We know what the kind of the pressure points are going to be. So it is a much quicker process. And honestly, even with, now when we're talking to new customers, outside of our existing relationships, that's quicker too, because you've been validated by a multi-trillion-dollar company. Right. So there's a certain comfort level, I think, once you sort of cross that Rubicon, and not only again with our existing partners, but with additional folks, that I think facilitates and makes it easier.
In terms of that design, and this was a topic that came up when we had a recent interview with Jason Les from Riot last week, about they're actually designing their home buildings now for Corsicana, and their modules are like 56 megawatts. Now, I'm a numbers person like yourself, Patrick, and I'm thinking 56. So if I multiply it by that's 168. Are they using similar sort of like design modules to what the likes of TeraWulf, and now we've seen obviously Cypher as well doing there? And is there, I mean, there's no such thing as coincidence, but is it a case of, would you say that is getting towards like a standard build now or do you think actually there's more to it than just the fact they're building that, they're designing to build those buildings now at that particular size? Does that say anything else to you?
Yeah, look, it's still very bespoke, right? This is not like you're building the 1,000 CCGT, combined cycle generating gas plant in the US, right? You're not. You're still building single digit, if not low double digit, high power density water cooled data centers, right? I mean, you look at who's got them under construction right now. It's us, it's Applied, it's Stargate with a couple, and Cypher. There's only a handful of folks that are doing this, right, in the US, and there's some private companies as well. So no, I think it's very bespoke. Again, that design that we came up with Google and Fluidstack, which is being rolled out nationally, that is their new design. And thankfully, I think as you guys have seen, Google has disclosed that, they are partnering with Anthropic. So that, you can imagine how difficult it was to keep that private for months on end. But that design is based on the Google TPU hardware. So the building and again, the PUE is not only a function, right, of where you are environmentally, meaning are you in Canada, are you in the Northeast US where it's just cooler, meaning you can get more power efficiency out of your gross megawatts, right, and have a lower PUE, or if you're in Texas, right, where it's just hotter and you need to consume more power to keep your data center cool, you're going to have a higher PUE. So again, but I think the power density per rack, right, is a function, and to your point, Anthony, back to like the actual module consumption, right? That is a function of what equipment you're using. Are you using, H100s, H200s, B200, B300? Are you using AMD? Are you, is it NVIDIA? Is it Google TPU? Is it Amazon? Like, what is the actual hardware you're using? And that will influence, the power density, the weight of the rack, the amount of cooling you need. So it is very, and now that's about the extent of a CFO's knowledge on the operations side.
Yeah.
The
It
rest
just
of the
it
deal
just
is
felt
like
it
this.
just felt from their update. I was looking at numbers like, and then Jason went on to say like they're using 14 megawatts, and it's like that's the lowest number, and then you build from that there, and it just happens that the numbers do sort of like the linked in terms of it feels there's a similarity there. But I mean, I was just reading. Maybe Fluidstack are going after right as well because there is this shortage of power in the US, and irrespective of which state you're going to be operating in, there's a lot of HPC going to be or expected to be delivered in Texas, and it's a case of there'll be lots of miners there looking for the next deal. I mean, it's great that you guys and a few of the other miners have got their deals, but there is a list of other miners now moving into that space behind you with some power, with some pipeline of power to deliver similar types of co-location or CPS deals themselves.
Yeah, look, and I will be their biggest cheerleader because rising tide lifts all boats here, and I can tell you,
Yep.
and we've been saying this for a long time, demand is bottomless right now. So this isn't a zero-sum game of I win or somebody else win. Like, no, there is just, and we've been saying this, and so I'm sorry if I'm repeating myself, but there is a dearth of foundational compute capacity. It doesn't exist, so it has to be built. Like particularly high power density, water cooled data center capacity. That just, again, doesn't exist. There's a lot of cloud data center capacity that was built right over 10, 15 years. But for the, AI specific functionality of high power density, water cooled, that's what we're all trying to build right now. And that demand is bottomless.
Just one final point before Bryce can pick up on the sort of like the revenues of the contracts.
Yeah.
In terms of that PUE, is the assumption that if you've got a low PUE, say 1.1 versus a PUE of say 1.45, is that difference in PUE the same level of power as the compute power? Or are we saying ancillary power will be a lot less in terms of usage? To support, so the power to support the compute isn't necessarily at the same level of power. In fact, the use, or are you saying absolutely it is? You have to use effectively 1.45 times the amount of power if you didn't need any PUE whatsoever. If you're in a perfect environment.
Yeah. So let me break that down. So in a cooler, environment in the like Northeast or Canada, where we are, up in upstate New York, what it means is I have more critical megawatts to sell, right? Because and again, I want to be specific about this because I
Yeah.
think there's a lot of confusion on PUE out there. PUE, like when we use, for example, at Lake Mariner, we kind of were guiding people to 1.25.
Yeah.
Okay. That is like the max, meaning on a 90-degree day with 100% humidity, that's in our lease like the max PUE effectively that we can achieve. The reality is like my team, operations team will tell me this all the time, and we have not changed our guidance, nor am I going to. But the average that we actually will realize at that site, right, is probably going to be closer to like 1.1 to 1.2. Okay, because again, there's times in the winter where I don't even need to use, like I'm on the dry chillers, not on the wet chillers or wet coolers. So I think that's important. Like, but the major takeaway, Anthony, is like if the key is like a site that's in a more benign environment where it's cooler most of the year, you're going to be more effectively more profitable because you have more critical megawatts that you can deliver from less gross. So that is a key point. And look, we're not all of the sites that we end up having in this company are not going to be all be the same. And we just showed you that, right, with this new JV, meaning we own 51% instead of 100. It's a 1.45 PUE, meaning 240 gross megawatts get you to 168 critical megawatts, right? And so, yeah, there's going to be some differences. But I think that this proves kind of like the old power companies, you need geographic diversity. You can't be all in one power pool like ERCOT. You're gonna need a diversified business. And you guys know I've been talking about this for a long time. But our view has been we need diversity of tenants and we need diversity of sites. So, I've got 2 tenants now. I think I'll probably have more in the future. I've got, now 3 sites in the company. I think I'll have a lot more of those in the future. And I think you're going to see us pick and choose particular power markets around the country that we think have really good supply demand dynamics and really good regulatory regimes. Like that's important.
Hey, just a quick follow-up on that one. You guys obviously have expertise in Bitcoin mining as well. Talking about that kind of delta between max PUE and average, do you see Bitcoin mining as a longer-term kind of power sink strategy for TeraWulf?
I don't, so that's a good question. I think, we will likely have some Bitcoin mining, I think, until the next halving. It's been a profitable business for us, particularly as we make this transition. So there's no reason with extra megawatts to shut it down. It is profitable and it provides a real service to the grid, right? I mean, being able to curtail your entire load within 10 minutes, which honestly is where we think actually data centers will get to as well as more of them are built and our end users can kind of move load around in particular regions or intra-region. We think they will become much more responsive as well. Because again, I mean, you think about, right, even with Bitcoin mining, you're talking about being offline 5% maybe if there's 8,760 hours in a year and you're offline 5% of the time, and that is A, massively reducing your power bill, and B, putting you on the right side of like the political discussion and with other folks around power usage and driving costs up for everyone. It's a simple answer. I think ultimately that's where the high power compute data center market needs to move as well. And it ultimately will get there as you build more foundational compute capacity and end consumers can kind of move it from one site to another in the same kind of general location. So yeah, I think Bryce, we'll keep mining Bitcoin. As you know, we have a little bit of a different approach to it where we mine it and sell it to kind of maintain that profitability. And I can tell you in this latest kind of swoon down, I'm even happier that we continue to execute that strategy. But yeah, it's a foundational part of the business. But I do think ultimately, right, when we look at what the high power compute business and co-location, where we specifically are focused, we are not doing GPU as a service, and I can expand upon that later. But it's to us, right, as all like longtime power executives, it's the same business, meaning in power, you would go get an offtake with a municipality or a utility or a credit-worthy entity. You would then lock in your fuel supply and you would finance the difference, the spread, to build your asset, right? And then you'd have a long-term asset with a fixed contract, fixed revenue, fixed margin, and you'd have debt that you would amortize down. And then once that contract came to an end, you'd do it all over again. High power compute and AI, it's the exact same thing. So it's a business that we're really comfortable in that, we think affords similar multiples to a lot of the public data center REIT peers out there over time. That is a much better long-term business to be in than Bitcoin mining or GPU as a service, which are incredibly capital intensive, right? Because they follow Moore's law. I mean, we're already designing when we're building these data centers, guys, we're designing for the next 3 to 5 generations of equipment, meaning we're building extra cooling lines in that literally just end at the rack and don't plug in. But so that ultimately, as the power density increases, the cooling is already there, and we can adapt to, again, the next sort of 3 to 5 generations of equipment. So that's already being built in. If you are in, Bitcoin mining or GPU as a service, and that's coming, that just means what your GPU or Bitcoin mining machine is earning today is going to dramatically fall off as newer and more efficient equipment comes online. So unless you have the cost of capital of Amazon, Microsoft, Meta, Google, you can't compete in that game long term. We just don't see how you do it because their cost of capital is among the lowest in the world, and they're going to win.
Yeah. Makes sense. And that's kind of a good segue to the next topic here. So you talk about some of these different models, the GPU as a service, the CSP, the colocation. We've now seen a number of these deals as well. So I know you have put together a kind of a comparative table here talking about some of the revenue, the different models. Anthony, I know you have some opinions on the risk tolerance of some of these models as well. So maybe we can get into that. You guys can kind of compare and contrast what we've seen so far and what you think Wulf's ultimate kind of outcome here is.
Yeah, sure. I think, I sent you guys a spreadsheet that we were looking at earlier today. And I don't know if you can pull it up on the screen, but really, again, I think the takeaway for me is we are all about execution. You look at our pipeline, right? There's no padded theoretical pipeline that's available in 2030. I mean, if shareholders wanted me to do that, we can do that. Because again, like I said, I've looked at 150 sites, and we're very, very close, if not imminent, on more than a handful of those that fit the bill. And not only that, but we have the best partners and best customers in the world right now. So I know exactly what they're looking for, right? So there's not a risk that I think I've seen with others that you add something in and it's either too small or in the wrong jurisdiction or the latency doesn't work, right? Or there's some kind of fatal flaw. That's not going to happen with us because the amount of due diligence and time and really opportunity cost, right, that we all spend on this pipeline is enormous. And so I think our approach has been, let's surprise the market. We don't need, like, we've proven we can execute. I don't need to telegraph it to everybody. I think they should understand at this point in time now, there's avenues of growth that we just, highlighted in the Abernathy JV, with the exclusivity to grow at that site, with the exclusivity with Fluidstack to grow at another site, right? There's avenues of growth in our business all over the place. And so one of the things that has been frustrating to me, right, as a CFO is to look at others that claim to have thousands of megawatts in the pipeline, which, by the way, 95% of which are all in Texas. And I just told you the supply dynamic in Texas is 85 gigawatt grid, about 75-ish of peak demand with 200 gigawatts in the queue. So if everybody that says they have thousands of megawatts available in Texas actually gets thousands of megawatts, the grid's going to collapse. Or what's more likely to happen is ERCOT's going to make new rules that say you got to bring your own generation, right? And then that means that's going to put those pipelines out 3, 4, 5, 6, 7 years, right? Because it takes 3 to 4 years to finance and build a natural gas-fired facility. So I think when I look at kind of us, versus our peers, if you look at sort of what is implied value in our stock for a pipeline, it's de minimis, and it's because I haven't sort of window dressed by saying, oh, there's thousands of megawatts that TeraWulf is going to announce. And so I just think folks have got, like, on the investment side, you have got to decipher between thousands of megawatts, again, that are in ERCOT, that are all coming on in 28, 29, and 2030. Because I got news for you, it ain't happening. Because again, if everyone who has 1,000 gigawatt site in ERCOT says that, then the grid's going to collapse. So there's just got to be, I think, an incremental diligence among the investment community that all megawatts are not created equal, and read where you are and what the supply demand dynamic is within that grid is really important. And those megawatts need to be risked, right, appropriately. And I'm not seeing that happening. And that was part of the reason why I sent you guys that spreadsheet. Is, some of my peers are getting literally billions and billions of dollars for what I view as like fictitious pipelines in their current stock price. And, I've having been in energy power now for, 25 years, which is why I have no hair left. Where I've seen people get really hurt is in the early 2000s when everyone started valuing power companies on a dollar per megawatt capacity, which is basically what people are starting to do in this space now. And in 2010s when people were valuing oil and gas companies on a dollar per acre basis without knowing what was kind of below the ground. It's like, well, guess what? Not all acreage in, Colorado has oil. Like certain parts are much more productive than others. So again, I just think it comes back to like not all megawatts are created equal. If you have a existing substation, existing infrastructure, what region are you in? There's a lot that kind of goes into that mix.
I mean, we've got obviously the three companies there, apart from yourselves, who've announced contracts, and I mean, Core Scientific literally had all their contracts in place before any of the others really announced a contract, and so the assumption would be there that having those contracts in place assumes that they've got that 590 or 800 megawatts if you include the ancillary power to deliver that contract going forward. And it's not all in Texas, to be honest. It's actually quite spread out across a number of areas in the US. So, but I sort of I hear what you're saying. That's an interesting thought about the Texas power and about the grid there and about the companies waiting to join that grid and the queue. I mean, I'm assuming. I mean, with regards to say Iron, who've had this massive ramp in terms of market capitalization from the market, the Sweetwater sites there. I mean, in their updates, they're energizing Sweetwater 1 next year. I mean, is there assumption that if they've already got plans to energize, or are you saying that's probably been approved and agreed to go forward, and Sweetwater 2 gets energized in 2027? That's 2 gigawatts of power there at effectively, two sites.
Yeah, look, but again, I think that there's a difference there. Like if you have an interconnect today, right, that says, okay, you can draw 1,000 megawatts of power today, that's real. If
Yeah.
you're saying, oh, I have an interconnect of 1,000 today and I'm going to get another 1,000 in 2027, I'll bet against that. Like let's open the bidding now. Right. I mean, again, you
Yeah.
have 200 gigawatts in the queue to connect in Texas. And I love Texas is an amazing place to do business. I've spent a majority of my career, like in energy power, other things in Texas, work in Austin, working with state legislatures, with the Public Utility Commission. They know how to get stuff done. But 200 gigawatts is, again, you're talking about effectively like tripling, 2.5x the existing grid. I mean, that takes a lot of time, a lot of effort, and the amount of megawatts that people are talking about over the next few years dedicated to data centers in the US, like give or take, it's like 40 gigawatts, right? So 40 gigawatts of data centers, and it costs, let's take the high end of my range where I'm telling you 8 to 10. And I'm mainly at 8 to 10 because I don't have to build a substation. Because up in Lake Mariner, I have one already. Cayuga, I have one already. And in Abernathy, we're paying the landlord to build it. So again, it's really more than that, but let's make math easy. 40 gigawatts at 10 million per megawatt. It's $4 trillion. And by the way, that's just the infrastructure. That's not even the hardware. Hardware, which basically is 4x the cost. So, I mean, when you think about, again, why we wanted to prove to ourselves and to our customers that we could basically go get our debt rated, right, this new financing structure that we came up with, Morgan Stanley and Google and Fluidstack, which we're really proud of, which has now been copied by Cypher, right? And imitation is the greatest form of flattery. So I'm happy for others to keep going and copying it. But that didn't exist. So we basically created this new IP to access a new pocket of capital demand because the private credit markets, right, couldn't finance this over and over and over again. And not only couldn't, there's just not enough capital in that world, but then, as you guys know, for our shareholders, of which management is effectively single-handedly the largest, we control 20 to 30% of the equity of the company together as a group. Financing ourselves at 10, 11, 12% was, you're just not creating any real equity value over the long term. So instead, with Google's support and now their partnership where they own 14% of the equity of the company, we cut that by literally basically 500 basis points, right? And our double B rated at 7.75, right? I mean, that's kind of the innovation that the space needs to attract the capital to keep on growing, right? Because this whole game for us, for anybody that's involved in the space right now, is you have four leaders: Google, Amazon, Microsoft, Meta, who have pristine balance sheets and are among the most profitable companies in the world. And so the whole game is, how do you partner with them to leverage their credit worthiness to the best of your ability to be able to finance it best for our shareholders? So that's what our focus has been, is trying to create.
He's saying with a real net income in their profit. So he's saying net.
Yeah. Well, again, and
no, I mean, I'm playing devil's advocate there. I've seen their balance sheets and seen their profit statements, and they are delivering significant amounts of net income across the board. Those companies.
Yeah. Look, this is why we're not in GPU as a service, because I don't want to compete with them. And two, when you do the math on these deals, right, particularly the one that one of our peers just announced, yesterday, I don't see any equity. And like, this is my job as a CFO. I don't see any equity value in those deals until year 6, 7, 8. And it's really at that point a function of what dollar per GPU hour. In other words, you're making a bet today on what the residual value of that hardware is in year 6, 7, and 8, because that's all massive equity upside if they still have value. And I can tell you, having been in the Bitcoin mining space and seen Moore's Law to a T, right? Like, the efficiency every year gets so much better. And by the way, there's great books on Silicon Valley and how Moore's Law, literally since the inception of Silicon Valley, has actually held true. So if you believe that, because I can see into the next 3 to 5 years of hardware development from all these companies, how is that GPU or going to be worth a lot of money in year 6, 7, 8? That's a bet that we're not willing to make with our shareholders' money, and other companies can go do it. And then the other reason, I don't want to compete with my customers. That's not, I provide a very specific service to my customers, which is, we know power and how to move power from a grid in and around a data center and get it to the building. Once I get it to the building, what they do with it, that's for them to figure out. And, that is complicated, like getting clusters of thousands and thousands of GPUs or TPUs to talk together and, perform generative AI. That's what they're really good at. I don't want any part in that business.
No, I think when I heard, I think it was like nearly 2 years ago, and we started hearing about the miners moving into delivering HPC services where they were starting to buy the H100s. And the first thing I heard was the payback period is 2 years. And I'm thinking, what? The payback period for the machine is 2 years? Yes. So we start earning revenue in year 3. I said, well, what about the operating costs to deliver that building and the operating costs that take part in years 1 and 2? Does that come out of year 3 as well? Because you just said the whole of the revenue for years 1 and 2 is going to cover the cost of the actual GPU. And at that point, I'm thinking that for me personally, as an accountant, it's like a risk too far, because I can't tell the future that far. Now, I am not a data center, someone with a lot of experience in data centers. I've been to visit a few, and I understand numbers probably like yourself, Patrick. but it's, someone would have to sit down and go through and show me the upside of how that to change my mind from the actual co-location deals, which effectively are phenomenal deals for providing, you know, warehouse services effectively. You
Yeah,
know,
and
you're building that, you're doing the build obviously like that, but once the build's in place like that, they're responsible for the power, they're responsible for the GPUs. You're just like managing the warehouse effectively, making sure. I mean, I don't want to down panic. There's probably more to it than that, but there's not. It's more managing the site. It's not.
yeah,
There's not any risk involved in that, and you're getting paid a handsome fee for delivering that process.
I'm gonna get photo bombed by my CEO.
Hey, how are you?
Guys, just
Oh,
want to say hi.
Good to see you.
You're with the smart one.
Come back and visit us sometime.
You're with the smart guy. Don't worry about it.
But yeah, no, Anthony, I agree, and I would add too, like for us, where I see the real upside, right, is my debt that I just put in place at 7 3/4, like secured by the assets that we're building for Fluidstack Google and for Core 42. That's amortizing debt. It's callable in 2 years. Okay. And I effectively am looking through to Google, right, who's standing behind the lease, who's got a, double A plus credit rating. So conceivably, right, if just bear with me, once I get through construction and the sort of risk that TeraWulf doesn't deliver is gone, and it's now a 10 to 20-year contract backed by Google, and you'll notice if you look at the terms of my debt, I can take out that debt. It's callable in 2 years. That was done on purpose because I think once we get through that period, that is very different risk. And if you look at Equinix and Digital Realty, right, who albeit are REITs, they finance themselves at incredibly cheap rates, and it's bullet debt.
yeah.
It's not even amortizing. So I want to get to a point where we're comfortable. And for us, it's, I would say, probably somewhere between 3 and 4 times on a total leverage basis, like all the way through the parent. But once I get there, like the massive upside in this business model is bullet debt. And then at that point, I'm going to have free cash flow coming out of my ears at the parent. Like that is the end game for us.
Yeah, the flip side to the argument, and this will be the argument. I mean, obviously, the likes of Google and Core 42, who are going to be bringing their machines in there, they've got to obviously produce a service that pays them to pay back the cost of their machines. But I think you just highlighted there, it's about the ability to raise that capital very, very cheaply. And even though miners are going to have really big names associated with them, and honestly, Microsoft are no small company when they go into that deal with Iron. I would imagine in the same way you've managed to get points shaved off the percentages for your debt. I'm assuming if they go down that route themselves and they haven't identified how they're going to raise the capital to pay for those 5.8, it might be leasing, it might be pay buyback, whatever. There's a lot of different ways, and I don't want to make assumptions, but for me, would Iron, even though they have a client the size of Microsoft, be able to get a deal as good as Microsoft in terms of borrowing, the rating that they would get, and because Microsoft, a company, sorry, in using yours, Fluidstack, will want to make a profit on the GPUs they're going to be putting into your facilities. So it's I don't want to say it's not. I'm saying from my perspective, I wouldn't want to carry all that risk of the unknown. I think that the co-location is very much like once you've got it in place, it will run itself. And then, you've obviously got potential extensions to it.
Yeah. And look, again, I think now that we've proven both to ourselves and to the market that we can execute this on a large scale, like the flywheel is in effect. So
hamster
now
wheel goes round,
right? Like, and you just saw what we just did at Abernathy, right? So now we can grow this business very quickly because we've got
and your confidence and your ability to go into meetings with other clients now, having got 4 deals behind you, is that is that much more. I'm assuming it's a lot more. I mean, talking to you now, Patrick, and looking at your demeanor now compared to speaking to you, say, 6 months ago, is a whole different world. It really is. You're coming across the positivity coming across today, having gone through that process, is different from what it was when you were going. We didn't realize you were going through that process when we spoke to you in podcast, probably during those conversations that you weren't allowed to say anything about. But you can see now that you're carrying that sort of like knowledge, and I suppose it's like the confidence to go to the next deal. You're carrying that with you to say, hey, we can do this.
Yeah.
There's our portfolio,
Yeah. I mean, we now have a playbook for how to
Yeah.
go execute, right? Which it gives me a lot more confidence because when my operations team signs a lease, I now know how I'm going to go finance it. So yeah, I mean, other than not having slept in the last 6 months, you know,
And
yeah,
one thing you guys have done that others haven't done as quickly as you guys is as soon as you've announced the deal, I don't know how it's quick. It's like the sort of like the financing deal comes out
yeah,
immediately following that. So nobody's got to then worry about how they're going to deliver this because
yeah,
these are some big deals here. I mean,
yeah. Look,
your total megawatts now in terms of providing the service now effectively equates to pretty much exactly what Core Scientific is delivering for CoreWeave.
yeah, look, and that's a really good point, Anthony. I want to touch on this because I would say I have gotten some negative feedback from shareholders that have kind of said, "Hey, why don't you after these deals that are get announced, like let the stock breathe, go and fair criticism." But to those folks, what I've said is I hear you, but your head's meaning my head, your head's not in the guillotine to go raise billions of dollars to get those deals financed. And so generally the way we've approached that to date is we don't want to take capital markets risk. So once we have a deal announced and we have a commitment to fund, we want to make sure that we have that capital in the company. And so I think what we just did in this last deal, where we did just over $1 billion of converts, what I'm really excited about in that deal is that funds our equity contribution into the JV. It puts multiple hundreds of millions of dollars on my balance sheet permanently. So I have a fortress balance sheet that can weather any storm. And it gives me some walking around money to go execute on the M&A that I've told you guys about on the 150 sites. So we are now, I mean, I feel like, from a CFO dreaming about we have ample liquidity no matter what to back up all of our commitments. And we're in a great spot to kind of grow the business. I will say, I think that it will be, and never want to say never, that will be our last, I think, transaction, Anthony, where, as you point out, where we announce something and then have to go to the market right away to fund it. I think now what you'll see from us, I think, is a cadence of, given the amount of liquidity we have, where we can announce a deal and then we don't really have big capital commitments for 3 to 6 months, so we can be much more opportunistic on when we go to the market. And again, we sort of been just we've all been playing off our heels here for so long because I mean, and it's super exciting to be in this space, right? I mean, you're talking like tip of the spear, new cool stuff with, Google, who's, a $2 trillion company. I mean, honestly, it's been one of the most rewarding parts of my career, and I think everyone here at TeraWulf to be in the middle of this, trying to come up with new structures with all these world-class partners and with Morgan Stanley, our partners there. I mean, it's phenomenal. But I think now I think we'll be in a much more sort of regular cadence that you would expect from a company that's growing and growing rapidly, but is like financially like in a really good spot.
That's great. Yeah, you can see both Anthony and you just smiling. Finance guys, obviously, you're in a great spot. I wanted to ask you, Patrick, we have a lot of people watch the show from other companies in the space, institutions. You've been through this process a few times. You've figured it out. You've had some, I guess, learnings along the way. What would be your advice to other people in the industry that are looking to sign kind of this initial contract in this space?
I would say this,
Secret.
Laird Hamilton, who's like one of my surfing idols, wears he wears a shirt that says T-shirt that says it's harder than it looks. And if I could kind of wear that around, at conferences, I would, because I remember when we were getting into this space, I was like, oh, this is going to be great. We've got all this power. We're going to grow like a rocket ship, and again, we've all been doing this a long time, and our team is really deep, which is awesome because there's times where honestly you're just exhausted and somebody else can kind of step in and carry the torch. So I think surrounding yourself with a lot of really talented, good people is really important. And it is hard, hard, hard work. And so I would just say it's kind of one of those times, nose to the grindstone. And yeah, it's difficult, and I could not be prouder of what this team has accomplished. And now I think, given we've got this playbook as Anthony and I were talking about, it's just rinse and repeat. So we're
And it's
excited.
just happened so quickly, Patrick. I mean, go back a couple of years ago, we were having conversations about this is our plan to reduce the debt, and we're going to be growing our Bitcoin mining hash rate to 13 to onwards from that there. And we've got this facility that we're only paying 2 cents a kilowatt hour. It's like those are the conversations, and literally in a very short space of time, we're talking about a global difference now in terms of what the company's delivering now going forward from what they were literally just a couple of years ago.
I mean, 2.5 years ago, I issued $30 million at 62 cents a share
Yeah,
because our backs were against the wall and we had debt, and right, the Bitcoin had fallen. So yeah, I mean, you go through, and I've been, again, just with my investing background, I've seen cycles, I've seen folks get into trouble. And again, I think that is the reason why we upsized our transaction recently, because I, I wanted, and Paul and Nazar and Kerry and Stephanie and Sean, we wanted to have a fortress balance sheet. No matter what now, we can perform on all of our obligations. And I think shareholders should take a lot of comfort from that. And I do get lots of inbounds. They're like, "Oh, you guys should announce all these pipeline assets or whatever." And I can tell you, we're not going to do that. What you're going to get from TeraWulf is what we've been delivering, which is execution. So head down, executing. And now that we got this playbook, just watch us go.
yeah. And I remember during that period there, you talked about issuing those shares at that price there. You had a CEO that was buying millions of shares from his own pocket to prove to shareholders that actually this was a company that you should be thinking about. It was, significantly undervalued. Obviously, hindsight's a great thing. We can say that now, but at the time, people were like, do I invest in this stock? Because it was. I think I bought my first shares in TeraWulf in the 50 cent range, and having sort of spent a few years looking at the miners and speaking to the likes of yourself, speaking to Paul on podcast, I was picking up information and sort of like it was helping me sort of work out how to invest my money. And I could see like this is sort of like a no-brainer. When the CEO goes and buys a big tranche of shares, that's got to give you some sort of like, it doesn't happen enough in this space. I mean, we know a lot of CEOs like to receive shares in the form of RSUs, but not so many are going out there and buying shares because they believe in the company.
Hey, I'm not chopped liver either. And I took a lot of heat from my wife on this. I spent hundreds of thousands of dollars of my own money, not net settling. So basically coming out of pocket, writing the tax checks for vestings at $1.50 and $1.90. So, and I have not sold one share.
One share.
Now,
Yeah.
again, the stock has run up a lot. So at some point in the future, my wife's gonna, put the gun to my head and be like, "Hey, we
Yeah.
need we need some of those funds back to put the kids through
And,
school."
and, and I don't think anybody expects shareholders to hold on to the shares, or I mean retail shareholders don't hold on to the shares that long. They'll switch between companies, and we've seen that with the volatility of the markets like that. But nobody's saying don't sell shares. Maybe don't sell shares the day before you announce an ATM or something. That's not a great sign. But if they're your shares, if you were to sell 100% of the shares, I mean, people would be scratching their heads and saying, "Why has Patrick sold his whole stake?"
But
But
by the way,
if you're selling
just
proportion to give yourself something, for the family, and so I don't think anyone's got an issue with
well,
that. I certainly haven't.
I mean, and you guys, I think were one of the earlier one, and I know folks at the time probably thought I was delusional and losing my mind, but I painted a picture for you guys of 20 to
Mm,
30 bucks a share.
yeah,
Yeah,
Remember? But
I
I was like, hey,
remember.
it's pretty simple. We got 1.1 gigs in the company that's over 1 billion of EBITDA at a 20 times multiple.
yeah,
Subtract 7-8 billion of debt. That's 12 billion on 500 million of fully diluted shares. That's 25 bucks a share. So
yeah.
I can tell you now, given what we've accomplished, and the sky's the limit. Like 20 to 30
Yeah.
bucks, in my opinion, is like off the table. I mean, I think this, company could be 30, 40, 50 bucks in a couple of years. Now that we have the flywheel sort of in play and can continue executing and raising
You're
capital at a really efficient rate.
you're seeing that re-rating literally on a daily basis by the analysts, the Wall Street guys there. I mean, we announce when we don't see them all, we see a fraction of the ones that come out, but when we see them out, we always sort of highlight in the podcast. We don't give price predictions ourselves, but we're quite happy to give a price prediction from Cantor Fitzgerald or H.C. Wainwright, and we've noticed there's been a sort of an influx of TeraWulf price market prices in the sort of that, quite right, in that $20 to $30 range there, and it's because you're delivering. It's not a case of you might deliver. You are delivering what people wanted to see, and obviously there's a queue of miners behind you, and whether they can start to announce some deals yourself. I mean, it sounds that with what you say with the power shortage there, and other CEOs have expressed the same, that we will see more deals coming through.
Yeah. I mean, 100% you'll see more deals. And like I said, really proud of Cypher and the deal they announced. I think I will be people's biggest cheerleaders because, again, I think rising tide lifts all boats, and there is a massive amount of demand. I mean, there's not enough power in the country, period, to meet these needs. So everyone, in my opinion, everyone will win. Now, what the economics of your deal look like, right? That's left to the prowess of the management team. So I think, again, not all sites are created equal, so not all deal economics will be equal. Speaking of
And
which, I
not
want to
not
talk
all cost structures are equal either, Patrick. So we only
true.
get to see the revenues.
Yeah.
And I love it when companies come out and say these are the revenues, and I can go through their accounts and say, well, actually, you're getting those revenues in mining, but when we started looking at your cost, your SG&A cost, your operating costs there, they seem to be higher than your peers. So it's not just about, it's about both. You've got to look at
Yeah.
revenues and costs. And what we're not seeing at the moment, obviously, because these are contracts on paper, and you're only going to start the process now of building these facilities to deliver that contract. Once we start seeing the revenues arriving on your income statement, along with the costs associated with the revenues, then maybe we can revisit some of these spreadsheets and say, actually, are those NOIs realistic? Because I mean, all four or three of those companies there were sort of suggesting that the Iron one's slightly different because of the fact it's a CSP contract. We're delivering sort of in the region of 80 to 85 percent NOI. Now, the proof will be in the results when they start
Agreed.
appearing,
But
because
yeah, but let me just comment on that because it's an important one. We guided to 85% on the deals at Lake Mariner. That just to give you, I think, some comfort and context there. So that came from our operations real time of Wolf Den and CB1, right, which are online and running. Two, we have multiple consultants, of which, for example, a company, excuse me, T5, out there
yeah,
who builds, owns, operates their own data centers.
data.
We
Yeah,
also had them come in, provide us kind of their, cost
they're
structure.
going to work with Bitfarms, I think, in Pennsylvania.
Yeah, I mean, they're widely used. They're really good. We like them. They're a great partner. So then we're partnered with one of the largest data center companies in the world. So you can imagine during the diligence process, they went through every single one of not only our construction numbers, but operational numbers to understand, right? So again, I feel obviously to your point, Anthony, until you're like up and running, you can't say for sure, but I feel pretty darn good about that figure.
Feeling confident.
Pointing out, Abernathy is different because we do not own the site and which we're not building the substation for, that's on the landlord. But the reason that that's 70% NOI, not 85%, is really just because we have to make a lease payment over the term to the landlord. So that effectively takes it from 85%, down to 70. And so but again, I think that's important because like as companies grow, it's not all going to be vanilla. It's not all going to be the same. You're going to have some chocolate, some Rocky Road, some Oreo, like whatever. And so, we're going to have, again, different economics at different sites. And the big difference is if you own a site, there's a capital cost to owning a site. You paid for it up front. So again, whether you lease it and over a lease term, it's the same amount of money as in a lease as owning it. One, you're just paying upfront. The other, you're paying over time. So, right, I think you'll see that among all of our peers. And there's one other economic thing I want to come back to because I think you flagged this and somebody else flagged it for me. And it was comparing our deals and I think some other peer deals, in particular, the revenue numbers at Abernathy versus the revenue numbers at Lake Mariner. And someone said to me, oh, if you take this total revenue number and divide it by the megawatts, it looks like you got a much better deal at Abernathy. That is not true. It's because the Abernathy lease is 25 years with an inflation adder every year for 25 years. So if you start that in year one and run that out, right, versus my leases at Lake Mariner are 10 years with 2 5-year adders to get them to 20. But the numbers I'm telling you at Lake Mariner are only 10 years, right? So if an inflation adder over 10 years, right, and then you divide by the megawatts, like the total revenue by the megawatts, may look like it's lower than the 25-year, but you have to factor in that inflation adder over 25 years is massive. So you have to kind of back that out on an apples to apples basis. So
your revenue figures for all your contracts include the additional uplift year on year then, yeah?
Correct.
Okay.
Yeah. I think that's pretty standard in the space.
No. And actually, so when we look at, so if you quote NOI and let's just use 80%, 80 to 85, doesn't matter which percent it is that NOI just the cash costs, or are you including depreciation and other non-cash costs in that figure?
That's just cash cost to operate the data. Yeah. So I'll tell you, it's really simple.
So depreciation, stock compensation will be additional.
Well, again,
to that.
I'm not owning the hardware. So you're talking about depreciating
infrastructure. Well, you'll have depreciation of post building.
Yeah. Building.
Well, again, it's transformers and building. Like you're talking 10 to 20 years, not hardware that depreciates over 4 or 5. That is the big difference. So, but just back to your point on the NOI, it's really simple. It's labor, security, insurance, and property taxes. That's literally the vast majority of all. There's some like other like IT costs, whatever. But that's why it's not overly complicated, Anthony. But
does the tenant pay all the power costs? Are they all passed through? All the power costs.
All the power costs are passed through.
Oh, so even the power cost to provide power to the admin rooms and whatever it is like that, on the whole site, then okay, that's good to know.
All pass through. And again, the way we account for that, you'll see is our revenue is grossed up for that, and our expenses are effectively grossed up for it too. So you kind of have to net those two out. And you'll see that this quarter we're going to start segment reporting because the leases for Wulf 10 and CB1 have commenced. So I think you'll start to see, a bit more of the detail into how that accounting actually works.
How, in terms of, and we don't need to know the numbers in terms of your income statement that you released this week for the end of September, but in terms of how much does that just relate to is the majority of that relate just to the Bitcoin mining business, or are you incurring costs?
Yeah, Anthony, we'll wait for earnings to address that last question.
I was going to
Thank
say
you.
we'll have to leave that one for another day. Obviously, always a very insightful conversation here. As you guys can see, earnings coming up next week. We look forward to hosting either yourself or another member of the team to follow up on that. I like what you said earlier, Anthony. Watching this progress, you guys are really on the tip of the spear here in terms of technology. You talk about how exciting this is, Patrick. We're obviously one step removed, but rooting you guys on from the sideline. And yeah, the transformation over the last few years, nothing short of incredible. So congratulations on all the success. You guys, if you have any questions we didn't get to, leave them in the comment section below. I'll hand it back to you for closing thoughts, but another great podcast, Patrick.
Thanks for having me, guys. Always appreciate the conversation, the support, the intelligence. I always enjoy getting on with you guys. So thanks for supporting the company. And yeah, just stay tuned. We got a lot more exciting stuff to come.
Thank
Yeah,
you.
sure sounds like it. Hit the like button. Feel free to subscribe. We'll see you guys back here tomorrow.